Interesting. Yeah.
Though a slight majority for the banking sector stress. Okay, shall we get started? Wonderful. Okay, good afternoon, everyone from Singapore, and welcome to the Gulf Intelligence Daily Energy Markets webinar. Today, for the 10th of May, 2023, I am Vandana Hari, founder and CEO of Vanda Insights, and today's guest host. So a quick look at what's happening in the oil markets. Economic worries continue to dominate sentiment. Crude prices got a lift late in the US session yesterday. The US Energy Secretary, Jennifer Granholm, said that the US may buy back crude for the Strategic Petroleum Reserve by the end of this year. And that's what provided a prop to crude. However, prices are under pressure again today. Brent trading at around 76.67 as we speak. If you'd like to check out a daily Asia morning report that we put out at Vanda Insights on just weighing all the factors that are impacting crude price movements, please do so. It's called Crude Insight, and today's report is appended in today's reading digest. So have a look when you get a chance. Welcome to my three guests today. We have Mark Oswald, a chief economist and global strategist at ADM Investor Services International. Vibhuti Garg, she's director for South Asia at the Institute of Energy Economics and Financial Analysis. And Henning Gloystein, director for climate and energy resources at the Eurasia Group. Welcome to all three of you. Mark, I'd like to start with you, given that, of course, I think sentiment in the financial markets is dominating the oil complex, but the sentiment has also been all over the place, hasn't it? The US banking sector turmoil, the market hanging on to its bets that the Fed will start to cut rates, and now we have the specter of a potential US government debt default. So I'd like to start by asking you, how are you weighing these three or any other potential factors in the financial markets with regard to their impact on oil sentiment?
I still think the most important one is the tightening in financial conditions, in credit conditions, and that is being definitely driven by the concerns about the US banking sector. The US debt default story, it's definitely a story. It's going to be one which we go backwards and forwards on for quite some time. But I think that the banking sector story is a more important one, because even if it isn't a banking crisis, and I don't think it really is, it's a particular banking sector crisis in the US due to bad regulation, bad supervision, and bad risk management. Amazingly, 15 years on from the global financial crisis, we have a lot of the same problems that we did then. In fact, one could say 30 years on from the S&L crisis, we still have many of the same problems that we had. But it is definitely tightening up, above all, lending to smaller companies. And smaller companies are the companies wherever you look, whether it's in Asia, whether it's in Europe, whether it's in North America, are the ones which create jobs. And if they are starting to see the credit spigot starting to be turned off, then that will have an impact on oil demand, on energy demand. And people are still, what people need to remember is, as much as energy prices have come down, when one looks at the complete complex, so gas, power, crude, they're still dealing with the overall increase, and it is having an impact on people's behavior, and they're also trying to manage the transition. So it's incredibly complex, but I think above all, that one is the most important one. And and the fact that China's recovery is proving to be as patchy as a lot of people expected, because as yet, the property sector crisis is anything but resolved. It's improving, but it's not resolved.
Yeah, hold that thought, Mark. I would want to get back to you with a little more detail on your views on China. But just going back to the points you made about the financial sector, are you referring more to the ripple effect of tightening credit conditions than, let's say, more dominoes falling in the bank market? Or you think that the latter is also still a threat hanging over the markets?
I think the latter is still a threat hanging over the market. The fact is that the Fed has raised interest rates by, basically 500 basis points in just over a year. And that is, we've not really seen those sort of interest rate increases in a long time. And people aren't used to dealing with it. Part of the problem is that the regulators and the supervisors basically didn't really account for such a, if I think of some of the banking stress tests that we've had over the last couple of years, that was considered to be an extreme event, whereas what's happened now is to a large extent normal. So, and the fact is we could go up, 600 basis points. Yes, I think the Fed is taking far more notice now that credit conditions are tightening, and it knows that will operate with a lag. Particularly, the biggest point here is really that a lot of people have fixed rate loans and they don't necessarily roll over when the Fed hikes rates, or the ECB or the Bank of England or anyone else. And it's only when people then have to refinance that it starts to hit the economy quite hard, and it will, by extension, hit energy demand.
Yeah. The Fed certainly seems to be taking much greater note of this credit crunch, but what it can do and what it will do about it, of course, remains to be seen. Vibhuti, since we have you on the panel today, I have to ask you, this was news earlier in the week, but one that caught quite a lot of people's imagination. Which was that a government-appointed panel has recommended that all diesel-powered vehicles be banned in Indian cities from 2027, which is not too far away. So, can you sort of help us understand what's behind this recommendation? And importantly, how feasible do you think something like this will be to implement?
Right. So if you look at the statistics, the transport sector consumes about 80% of the diesel as against the non-transport sector. So definitely the diesel consumption is the highest in the transport sector in India. And this kind of a regulation came into effect just for one city, Delhi, and all its national nearby adjoining areas, which is called the National Capital Region. So any registered diesel vehicle over 10 years old and petrol vehicles over 15 years old could not operate in Delhi NCR region. This was kind of a decision was taken a few years back when Delhi NCR region was struggling with huge air pollution problem. But since the last couple of years, this has been extended on an year-on-year basis. And even now, this condition is still valid during most time of the year, because vehicular pollution is one of the biggest source of air pollution as well. And when it coincides with stubble burning and all, that's how the government came into action. But now this regulation of, banning diesel powered four-wheelers in all major cities by 2027. And this regulation also has a clause that cities which have more than 1 million population, it will be effective there. The fundamental reason behind this is primarily to combat air pollution, but more importantly, to accelerate adoption of cleaner mobility solutions as well. So India has made a target of 30% of electric vehicle penetration in private cars, 70% in commercial vehicles, and 80% for 2 and 3 wheelers by 2030. So this kind of regulation in cities will help in achieving that or accelerating that. While there could be temporary issues, but if we can couple this with strong public transport in the form of expanded metro coverage, And also, electric bus connectivity, this issue can be addressed to some extent. And to
Right.
that extent, the government has also said beyond 2030, no new state bus on any other form will come up, but it has to be necessarily electric bus only.
Right.
So yeah.
Right. But just to be clear, Vibhuti, this is still a panel recommendation. It's not been adopted as a regulation yet, right?
Suggested, but it's yet to be implemented.
Yeah. Do you see it being adopted?
There will be a lot of resistance, but it means that it's gonna be maybe implemented in a phase-wise manner. So probably bigger cities which have much better, other public transport, it can be done in those cities, but cities which do not have a strong public transport system, it's very, very difficult to implement there.
Yeah. And I suppose probably it might be wiser to depend on a mix of maybe compressed natural gas in the mix as well for vehicles, because you have to assume readiness of all electric powered vehicles to take the place of diesel fired ones, right? Which might be a bit tricky.
Yeah, so there is a strong push on CNG as well, and also ethanol blending, which I think spoke about last time. So India is a strong push for ethanol blending with petrol as well to kind of, address this whole demand issue. But yeah, I think diesel is more higher emitting carbon house source. So that's where the main challenge is, and that's what the government is trying to address. And the use of diesel cars or diesel transport is more on commercial vehicles rather than private cars. There are private cars, but yeah, public transport becomes very, very critical to address when we talk about the diesel vehicles.
Yeah, so all the buses and trucks on Indian roads. Thanks for that explanation, Vibhuti. Henning, if there's one topic that is dominating global geopolitics, and it has implications in areas of war, trade, diplomacy, de-dollarization, you name it, it's the growing animosity between the US and China. How do you see this dynamic playing out in the energy sector? So let's say, in the medium to longer term.
Yeah, thanks, Vandana. It's actually, we think it's already playing out because, of course, the Russia's invasion of Ukraine saw that China is maybe not openly siding with Russia, but it's really not siding with the Americans and the Europeans in their opposition to Russia. And that has fed into the energy war, or into an energy war. So Europeans have phased out Russian crude oil imports and refined product imports. They are now scratching their head on whether they could stop LNG imports from Russia or not. And China is still buying Russian oil. It's certainly still buying Russian LNG. So is India, for that matter. So we are already seeing that there's a divide in global oil and gas supply into those countries who still want to deal with Russia and those who don't. And it actually goes beyond Russia as well. So this has been going on even before this war. The US sanctions on Iranian oil are being, adhered to modestly to not at all in large parts of Asia, and especially by China. Venezuelan crude oil is still going to parts of Asia as well. So you have these fleets of tankers of oil that is sanctioned by a coalition led by the United States that is still going to Asia. And there are people starting to talk about good and bad oil. That is a little bit of a Hollywood term of the issue, but you can see here how geopolitics is splitting what is essentially used to be a global market. And okay, it's possible. No one's really running out of oil at the moment, but it's costing a lot of money. Some people are taking advantage of discounts for sure. India is the most famous example here as well. But of course, they are refining cheap Russian crude oil and selling it back to Europe. So it's not just the Indians who are taking advantage of this. But overall, these are dislocations of what we call them at Eurasia Group, because they force oil and also gas into directions which under normal market conditions wouldn't make any sense. And that means they cost more money. And that is, I think, the cost of this wedge that is being driven into global commodity markets, but most notably oil, by the geopolitical splits. And we don't really see a solution to this or an end to this anytime soon.
Yeah, you mentioned Iran, and there were some reports recently that the capturing of 2 tankers by Iran was sort of as a result of a tacit go-ahead or encouragement from Beijing, because Beijing did not like the fact that US authorities had seized a tanker of Iranian oil that was headed for China. So, and then we've seen China play a greater diplomatic role as well in the Middle East, played a part in bringing Saudi Arabia and Iran together in diplomatic relations. So do you see sort of a greater influence of China in the Middle East and sort of in diminishing influence of US in any way shaping future flows as well, energy flows?
That's very possible, yeah. I mean, all what you just mentioned, I mean, the situation, the tanker seizing in the Persian Gulf, or the Gulf in the air in general. And the other part is that the deal that you mentioned between Saudi Arabia and Iran would not have been possible under current conditions led by the United States. So, one should be careful in just dismissing everything that China is doing here. This is, for now, this is a positive development. And one that the United States in its current conditions wasn't able to support or to create, foster. And the other aspect is, of course, that China, even before this crisis started, was quite quietly but actively engaging in Iran. So they had already said a few years back that they wanted to access Iranian oil. They have what they call Chinese asset oil in Iran. They basically are of the position that, well, if the Americans, Europeans don't want to buy Iranian oil, we will. And that is a view, I think, that is also quite commonly shared in India, because just the proximity of it. Iranian oil is a natural supply to India, to Asia. Yeah. And if for political reasons the West doesn't want to take it, then it will find its market. And overall in the Middle East, I mean, there's been lots of talk that the US will disengage from the Middle East to some extent, and China is actively engaging more in the region. The latter part of that China actively is engaging more is definitely true. Whether the US is really losing its interest in engaging in the Middle East, I'm a little bit still not convinced by. There's a lot of personal politics involved there. Of course, the one famous one is that US President Joe Biden and Mohammed bin Salman of Saudi Arabia really don't get on. That could change in the United States depending on who becomes president next year.
Yeah, sure. Fair point, Henning. Thanks for that. Mark, I'd like to go back to your point on China. And we had a slew of trade and trade data from China yesterday, including oil imports and refined product exports. And we had manufacturing data earlier, which showed a contraction in April. So overall, the way it's being described is that Chinese macroeconomic data has been mixed to perhaps a bit disappointing. My question to you would be, do you think the optimism over the economic recovery, especially what the amount or the degree of optimism we saw earlier in this year, over the economic recovery picking up momentum in the second half of the year for China, do you think that optimism is still valid?
I think the perspective that it will pick up in the second half of the year is correct. I think the biggest problem that we have in financial markets at the moment, and this impacts even into physical commodity markets, above all energy, is it's always pendulum swings. It's everything on black or everything on red. So when we talk about a recovery in China, we expect it to be as it was before, which it was never going to be. The changed geopolitical aspects, the greater demand for self-sufficiency in China, the dislocations that Henning was talking about in terms of energy and commodity flows meant that it wasn't going to be. So I think the problem is the perspective. So it's the fact that we keep on going, oh, well, it's not 8%. if we're talking about retail sales. It's not 7 or 8% in GDP terms. That's disappointing. And then suddenly the pendulum swings the other side. Oh, China's going to go into recession. Somewhere in the middle of all of this is where the truth is. And that applies actually not only to China, but also to Europe and North America. I think the biggest problem in terms of energy, in terms of the global perspective, is has been, Asia can now capitalize on the cheap energy which is becoming available from Russia. The US still is basically largely self-sufficient because of the shale oil boom, and Europe is caught in the middle, basically doing what the US wants, but without the internal resources to be self-sufficient. And that's where Europe actually becomes piggy in the middle. And that's probably the biggest danger of all, because that could see some fracturing between the EU countries and the UK on the one hand, and the US on the other hand, because suddenly they're just going to say, well, we've got so much underlying inflation pressure from energy, and the US is asking us to do this, but it doesn't really serve our own purposes, and we need to rethink where we're going with this.
Yeah, Europe being sort of squashed in the middle is, I'm completely with you on that. And to Henning's points earlier as well, we've increasingly seen a lot of Western European countries also getting torn between sort of loyalty, if you will, to the US versus loyalty to China. And they don't necessarily want to see things as black and white. I was just reading Italy, for instance, is withdrawing from Belt and Road under pressure from the US, presumably. So on that point, absolutely, I'm with you. Just on the China recovery story, there's quite a marked divergence between services, which have been picking up phenomenally, the services sector, versus manufacturing. Do you make much, or do you think the market is making much of this divergence, or do you think that's the anxiety as a result of that the manufacturing is not picking up at a good pace? It is a reason to worry about Chinese recovery?
To a certain extent, that's what the market's picking up on, though what's happening in China actually is a mirror of what's been happening in the US and the Europe post-COVID. Yeah. What we saw basically was a strong demand for anything to do with manufacturing. During the COVID period, services was weak. Now we've seen a swing back towards services demand. The problem in China, and they've been talking about this for at least 10 years, that they are trying to get a much more services, private consumption-led economy, and they're really struggling with that. And the primary reason for that is basically the property sector, because they want to get that swing going on. But right now, given that roughly about 70% of Chinese savings are tied up somewhere in the property sector, a lot of people have lost a lot of confidence, and it's going to take quite a lot of time to restore. Confidence is easily lost. To restore it takes a lot of time.
Sure. Yeah, well, that's a good segue to our survey question today. And I'd encourage the respondents to not be influenced by Mark's views. The question is, so the Jan to April macroeconomic data that we've seen from China so far, what does it suggest about the country's rebound? In your opinion, will it accelerate in the second half of the year, or will it sort of stay flat? H2 looks pretty much like H1, or will it decelerate? So more headwinds coming towards China in the second half of the year. Please go ahead and have your say on that question. I have cast my vote. Right. Vibhuti, let's talk a little bit about the renewable energy sector in India, of course, which the country has been very, very sort of strongly, the Modi government has been advocating quite strongly. But last year, India dropped its target of adding 500 gigawatts of renewable energy capacity by 2030. Is it adding or having? Please correct me on that. But it decided to give itself more. Sorry?
Yeah, it targets to have 500 gigawatt by.
To have, okay, a total. But it dropped that target, right? Last year, it wanted to give itself more wiggle room, I suppose, to continue setting up more coal-based power plants, which indeed it is doing. So given that scenario, and given that, funding costs are going up. Then the US IRA is also pulling away a lot of capital that could have gone, let's say, into countries like India in green energy projects. How do you expect India to fare with its renewable energy targets this year or in the near term?
Just to clarify first that yes, at COP26, Prime Minister Modi announced that India will have about 500 gigawatt of non-fossil fuel sources. But last year, at part of its revised NDC, India did not mention the quantity, but it still mentioned that 50% of the total installed capacity will come from non-fossil fuel sources. And if you look at India's energy demand, it would, 50% of capacity will be non-fossil fuel, it will be close to 500 gigawatts. So I think while it may not be an absolute target as part of NDC, but it means we will be needing about 500 gigawatt of non-fossil fuel capacity by 2030.
Okay.
In terms of, yes, with the increase in financing costs, which has led to high inflation, we did see short-term impact in the sense that financing cost is a large component of your tariff that gets determined. So we have seen renewable energy tariff going up by 30 paisa because of financing costs, as well as in India, there was also an imposition of basic custom duties on imports of modules and cells from China, which also led to higher renewable energy tariff. So this imposition of duties as well as higher financing costs has led to high renewable energy tariff, but at the same time, it is still lower than cost of setting up a new fossil fuel-based plant, a new coal power plant. So it is still attractive to build renewable energy, I would say. From that cost competitiveness perspective, while the tariffs have gone up, but it hasn't led to, still there's a lot of interest. However, I would say, yes, because of Inflation Reduction Act, again, there has been some impact in terms of international flow of capital to India, because there are some policy risk or, off-taker risk, which the government is coming up with very strict regulations to address them. But the investors are finding it more lucrative now because we just mentioned, the interest rates have gone up by 500 basis points in US itself. So given the attractiveness of the interest rates in the US market and government support through Inflation Reduction Act, a lot of budgetary support being given for domestic manufacturing of, electric vehicles, batteries. So there's a lot of investment going within US, which otherwise they were finding Indian market very, very attractive. So yes, I would say the financing flows have hurt to some extent, but we are still seeing that happening, but definitely it has slowed down a little, I would say, because of the Inflation Reduction Act, yes.
Okay, but doesn't sound like very strong headwinds. So that's reassuring for those planning to and looking to invest in India's green energy sector. Henning, the European Commission President von der Leyen announced the 11th package of proposed new sanctions against Russia yesterday, I believe, when she was visiting in Kiev. And we've seen reports recently that part of that package are proposals aimed at targeting sort of dubious activities that are facilitating Russian oil exports, STS transfers, and certain vessels just turning off their sat-nav systems and so on. My question for you is, what from this 11th package, and I suppose it now has to be deliberated and taken to vote by the 27 countries, but what can we realistically expect this package to change in terms of, because, again, especially in this part of the world, China and India, to some extent, refiners are always on tenterhooks as to what more could come in terms of sanctions to prevent them from importing Russian oil. So, what do you see coming out of this package in that sense?
Yeah. So the European Union's or European Commission's plans now, they're mostly I wouldn't, maybe window dressing is a little bit too cynical, but this is, as you say, plugging holes. The big low-hanging, well, even though not low, the big action with the product and crude shipment import bans have been made, and the financial sanctions have been implemented. The STS bans, for instance, now on the transponder, and they're trying to prevent ships from switching off their transponders. In the case of the European Commission, is aimed at the Mediterranean, because there's been a lot of STS shipments there in or close to European waters. So that's the one they want to avoid there. The European Union will not take action, secondary sanctions actions in East Asia. They've got no ways of implementing that. If that ever happens, it will come on US initiative. And as far as we understand, the US is at this stage not willing to do anything here, because in the case of India, India has made it really clear to the US and to Europe that they see this as a European conflict. They sympathize in theory, but they do not want to be affected by sanctions. And if that was the case, India would start to derail all sorts of Indo-Pacific trade and security partnerships. That's not worth it. And I mentioned before that Indian refiners are actually sending refined products made from Russian crude oil back to Europe. So it's a backdoor for Europe as well. In the case of China, of course, the US would like China to comply more with Western pressure not to buy Russian oil, but they're not that desperate, and they really don't want to pick a fight with China at this stage. The plate of conflicts is full enough. So at this stage, we do not expect secondary sanctions to be imposed by the West, especially by the US, unless the war in Ukraine escalates that much further, more atrocities than we've seen already, which sadly, of course, is not impossible, but at this stage, we don't expect it.
Yeah, which one never knows. But thanks for that, Henning. I'm sure it'll come as a major relief to at least our viewers in Asia, well, China and India, as you mentioned, primarily. That would just want to be able to buy that crude, which is coming their way at substantial discounts. Wonderful. We've come up on the hour. Let's have our survey results. Okay, so a little bit more majority think it will stay flat, which is where I voted as well, which is in terms of the momentum, economic recovery momentum. Next is will accelerate in second half. And nobody thinks it will decelerate. Okay. So there isn't a great deal of pessimism with regard to China either. Okay, that's interesting. Wonderful. Thank you so much. To my three panel speakers today, Mark Oswald, Vibhuti Garg, and Henning Gloystein. Thank you so much for your time and sharing your fantastic expertise and expert views. We have a halftime talk, which is just up on your screens with Jamie Webster. So tune into that. And with that, thank you very much for today. And have a great day. Thank you. Bye-bye.
Thank you.